All right. So, time is of the essence this episode because we are talking about Silicon Valley Bank, its collapse, and what that means for the startup community, the greater world of innovation, and the shifts we might expect to see with some of the bigger tech platforms too. So with me today is Dave Oldham. He's a serial entrepreneur, investor, and startup advisor based in Salt Lake City. He's managing partner for Formyl, which is his own consulting firm. Dave likes to build cool stuff with cool people, which I will take as a compliment because we got to work together back in late 2014 and early 2015. Hey, I'm cool, right? Tell my mom.
Absolutely. Coolest cool people I've worked with, yes.
But first, welcome to this week's episode of Make Sense. It's a video podcast that simplifies complex issues at the intersection of tech and people. There are a lot of them. So whether you're totally hyped on artificial intelligence, you're ready for the robot takeover, or you want to crawl into a cave and delete all of your social media accounts, I'm here with my guests to help make sense of what's going on so we can all design ourselves into the future. My name is Lindsay Tabus. I'm a product market fit strategist and innovation advisor. I've always been obsessed with designing technology for people. So let's get started. Dave, how are you?
Great. Thanks for having me on. This is awesome.
You are welcome. I'm so excited to catch up with you. I always enjoyed our conversations and working with you, and so glad that we've been able to keep in touch for 8 or 9 years now. So that's awesome.
It seems like yesterday, man. Time's gone by fast.
Well, so last week I introduced this idea of segments into Make Sense, and we're going to start with our first one, which is, what do you know? This is where us relatively intelligent tech ecosystem insiders discuss what hot mess has made national news from our industry. We don't claim to be experts, but we may know more than you do. So Silicon Valley Bank, do you want to take a stab at explaining what happened March 10th or so?
Oh, just a high level? Yeah.
Just that,
yeah. So everything that we know, at least that people in my network know, is that nothing fraudulent, nothing nefarious. I've seen some of that rhetoric on social media, and I totally think it's dangerous and totally incorrect.
Mm-hmm.
But Silicon Valley Bank has been a bank that has been largely focused on startups and on the tech community. And they've been wonderful, in my opinion, at providing tools and flexibility for startups and entrepreneurs around managing their money. They've been really, really generous with loans to startups to help them, fund payroll and do other things when things were tight. So I think they've been really big supporters of the tech community and startups. And in addition to that, a lot of the venture capital firms that invested in those startups also had their own, fund money managed by Silicon Valley Bank and in Silicon Valley Bank. And towards the end of last year, there were a couple of financial analysts that kind of raised a little bit of a red flag and said, hey, Silicon Valley Bank is holding a large percentage of their capital in these hold to maturity bonds, which a hold to maturity bond is something that you say, I'm going to invest in this bond, or I'm going to buy this bond, and I hold it until it matures, like 7 years from now, 10 years from now, whatever. And it's at a fixed interest rate. And the fixed interest rate and the hold to maturity became the problem as the Fed, in trying to, combat inflation, has it significantly increased the interest rates, and very aggressively still increasing the interest rates because inflation still, they haven't been able to get it under control. And that put Silicon Valley Bank in this position where a lot of these bonds and a lot of the investments that they held were underwater. They were not worth
less.
Yeah, than what they paid. So they had to do a write down, or they had to kind of correct, say, hey, we're writing off, a pretty significant amount of money. We're talking billions of dollars. We're writing this down. And that they made an announcement, I think, towards, I think Wednesday or Thursday of last week, that said, hey, we're writing this down. And that caused the stock market to kind of react like, hey, we're downgrading Silicon Valley Bank. And then that subsequently caused several large VC firms in Silicon Valley to say, hey, our money might be a little bit at risk here in Silicon Valley Bank. Now, I don't agree with that sentiment. I think there was maybe unwarranted panic. That's just my own personal opinion. But a couple
That's what happens to cause a bank run is panic.
Yes, exactly. So I think everything would have been fine if everyone would have just kept their money in. The problem is it's prisoner's dilemma, right? Those of you who don't know what that means, it's you get prisoners in separate cells and you see, which one's going to rat the other one out first. And in this particular context, it's, hey, if a couple of big VC firms that have a lot of money in Silicon Valley Bank withdraw their money, then everybody else starts wondering, like, well, I got to take my money out because no one wants to be the last one,
right,
like holding the bag or not, like with nothing in the bag, right, with no money left. And so a bunch of the VC firms started calling their startups when they started to see these deposits going out, and they withdrew their money, and it caused a run on the bank, which has, I don't think I've seen one of those in a long time. But it happened, and I think it was also fueled by social media, which is it's definitely a new concept since the last bank run, right? And so you got, very influential people. I'm not going to mention any by name because I'm pretty upset at several of them. But a couple of really influential people started panicking and on social media said, hey, this is a catastrophic event. This is a, extinction level event. And it just caused a ripple effect of panic, and everybody started, pulling their money out.
Yeah. So to kind of complement and add to everything you just said, there in the news, you kind of alluded like certain people are being called out as having caused this panic, or also that some people think there are nefarious things going on. For instance, like the execs paying out those bonuses. If everyone didn't freak out and cause the bank run, the bonuses were money due from 2022, right?
Yeah.
So it just looks fishy.
It looks really bad. Yeah,
it looks really bad. The optics are really bad. So it's like, feels a little more than just coincidental.
Yeah.
And then the other part being, the person that, better or worse, Peter Thiel, evokes lots of strong feelings from different people.
Yeah.
But he's just like the loud, obvious one that, withdrew his money and told all of his portfolio companies, which are many, to withdraw their money. But he wasn't the only VC. He was just the one that the public can see and recognizes by name.
Yeah, he's pretty vocal. And there were several others. He wasn't the only actor. So you're totally right. Now, the good thing is, and I support this at least, that the Fed came in, and on Sunday, they were holding a special session just for this. And they said, okay, we're going to backstop this, or we're going to at least guarantee all the funds that were in the bank for depositors. This is a really critically important thing for people to understand, because I've seen a ton of people who don't know what the hell they're talking about posting on social media. I wouldn't call this a bailout. And no. They're backing the depositors, which are the companies that have money in the bank, their deposits in the bank, is not protecting, the rich people, just rich getting richer. This is the small and medium-sized businesses that are just trying to make payroll. They had their money in their savings and checking accounts, and suddenly it's gone, right? Like that's who this is protecting. And even if you want to come at the VCs, the VCs, like a huge percentage of this money isn't their money. It's money that they're stewards over, that are pension funds, that are retirement funds, that are, educational endowments. Like it's everybody's money that were in these venture funds that I think it should have been protected. But the thing that's critical here is that the Fed has not said that they're protecting the management or the shareholders. So people who had invested in Silicon Valley Bank are out. They're screwed.
Yeah.
Their money is gone. Their investment written down to zero. And then this management, there's going to be an investigation, from what I've been told, what's been publicly said, into the management, and these recent bonuses will come under scrutiny. And if it looks like that they knew what was going to happen, they were anticipating that to happen, and they tried to take money out before, that money could get clawed back, and or there could be criminal prosecution, right? So the people are out there screaming like, hey, this is just, rich people, the government protecting rich people. I think that's a incorrect narrative. And I think that there still could be some really serious consequences for those people who are in the top decision-making positions. That I think that the mistake that they made was that they were more exposed with these long-term bonds than a lot of other banks were, and that financial analysts would have recommended. Going back to, almost 6 months ago, a few people raised the red flag of like, hey, these guys are kind of overexposed. Should somebody do something about it? And that, I think that mostly fell on deaf ears. And now those guys are looking like, I told you so,
Right. Well, there's a lot of factors here, and this is where, me as a Reddit nerd, I opened up Explain Like I'm Five subreddit, and someone did have a great explanation for this. They said, hey, you have so much money in bonds, in these long-term bonds, and the government is basically saying to SVB, hey, we're going to raise the rates. These bonds are going to be worth less. And are you sure you don't want to hedge and invest in some other things? And SVB was like, no, that's okay. And then a couple months later, hey, you're still in this position and we're going to raise my rates again. Like, do you want to hedge against this?
Yes.
Right. So that was like one of the big mistakes, is that they didn't have any hedging against.
They were exposed more than they should have been, and more than any other bank was.
Right. I mean, the other thing, and why it's caused like a lot of a panic as well in our world, is because like 95% of their accounts had more than $250,000 in them, right? We're talking about seed startups that just closed a $1.5 million round and just plopped that money in SVB. They didn't keep 1 or 2 months payroll in another bank account, right? So that panic late last week and through the weekend, not knowing whether anything above 250 would be covered, really also caused a lot of the hysteria in the startup world. So that's what we're talking. Yes, there are very big venture funds. Dave is absolutely correct, though. A lot of those venture funds, 1% of Michigan's teachers' pension fund might be in this venture fund, right? Because they have to diversify their pensions. So, we're not talking about paying off the actual shareholders and execs and making them whole. We're talking about a lot of startups that have to make payroll, and a lot of venture funds that are stewards of other people's cash.
Yeah. And if the Fed wouldn't have done what they did, then from where I was sitting in Salt Lake City, a bunch of the firms, other startups, were looking at their bank accounts that were not in Silicon Valley Bank, any of their bank accounts, and saying, hey, how much of our bank account is insured by the FDIC? And anything over that, we're going to pull that out. Mm-hmm. And so it would have caused a run on hundreds of other banks, and probably caused a economic collapse in a bunch of areas. It could have been a really, really scary thing. And so I think they did what they needed to. They acted quickly, which was, in my opinion, uncharacteristic of the government. So I think it was good. And to your point about, this, there were a lot of companies, almost every company that I've worked with has more than $250,000 in an account. And that's been kind of the max insurance from the FDIC. To put that into context, if you have 100 employees, average paid employees, your biweekly payroll is going to be more than $250,000. So we're not talking about like only these massive companies like that have tons of money and like who should care about them anyway. We're talking about like small and medium sized businesses that couldn't make a single payroll beyond what's in their bank account being at risk, right? So it was a pretty big deal.
That kind of brings up the next question is, and for context for everyone else, like it's called Silicon Valley Bank, but is it only Silicon Valley that's affected? Like, what about the startups in the rest of the country?
Yeah, no, great question. I think almost every company that I know in Utah had some money in Silicon Valley Bank. So they have a really big presence, at least here in Utah.
Yep.
Our nickname is the Silicon Slope, so maybe we're more closely affiliated with Silicon Valley than maybe the mid east and or the East Coast. But I think a lot of companies that are in kind of the growth and startup mode, there were so many things that Silicon Valley Bank did immensely well for startups with tools and the flexibility, like I mentioned before, that they were a very, very attractive, but sometimes even the only option that startups had, because other banks wouldn't take their money, wouldn't give them the tools and the flexibility that they needed. And so Silicon Valley Bank, I think it's sad that the demise of it, and I think we desperately need another bank to take its place, especially in the startup community.
Yeah. And so to augment that as well, as SVB has a very strong presence, I believe, across the country at this point, right? They sponsor a lot of startup events. It's in their interest. And that's kind of one of the weaknesses as well that brought them to this point, and that they're done, is that almost all of their accounts were in this like non-traditional asset, right? Like a startup world, venture funds. And I think they also had 10% of their assets actually invested in venture as well, which is a large proportion compared to other banks that invest in venture. And so this does not affect, like the short answer is this does not only affect, Northern California in general. It affects startups around the country, as like Silicon Valley, the term has come to represent the startup world, not just a physical location.
But we should point out, and I think we were starting to point out, that it would have been way bigger than Silicon Valley Bank had the Fed not stepped in and stopped this, because everybody that had money in any bank, and whether you're a startup or not, all businesses were starting to talk about, okay, how much money do we have in the bank? How much of that is insured? If not, maybe we should pull our money out of this bank, because who knows how far and deep this is going to go. And it could have caused widespread bank runs across many other institutions that haven't been exposed like Silicon Valley Bank. It's a ripple effect that everyone's panic would have, kept going, I think.
Yeah. And from what I understand, the loss, the $2 billion loss that they were going to write off for these bonds on maybe 20 billion worth of bonds or something more than that, like the assets of the company still, I think, could support the depositors' accounts. It's the shareholders they couldn't support. So that's an interesting place. I don't want to get too drawn into on this call, but how the FDIC, breaks up these companies is another Explain Like I'm 5 that I can post in these. It's really, really, really fascinating. So I want to take a switch to our second segment called What Does the Future Hold? So we can get our 8 balls out or something. This is where I just call out some interesting predictions for 2023, and the experts, my guests, tell us their hot take. Will it happen? What's real? What's behind this? So first a topic that has come up on Make Sense before, which is, and I know you have experience, a lot of experience in social media. It was one of the early companies you founded, but social media users are going to turn their back on the algorithm. So this says that users will choose more private spaces over big platforms. We'll see the rise of smaller platforms like Post and some others. So what do you think? Are social media users going to turn their back on the algorithm?
I think so. I see a couple of emerging trends with that, but overall, I totally agree with that sentiment. I think people are becoming more aware of how they've been used and abused. Our data has been used, and we've been made into the product, basically. In exchange for these platforms being free, we've become advertising targets and gave up a tremendous amount of privacy and a tremendous amount of information about ourselves unknowingly, so that Facebook and Google and others could make a lot of money from advertising to us. I think that heightened awareness around privacy will cause people to a certain segment of people, and I'll circle back to that in a minute, but a certain segment of people will look for platforms that protect their information, and potentially, I think, even be willing to pay for platforms that don't advertise to them, that don't use their data, but still give them kind of the original promise, but in a more pure and genuine way to connect, because we still all want that good aspect of social media, connecting with each other, sharing photos and videos and commenting and having discourse and that kind of thing. I think that will always be a super valuable thing, but we'll get into the rise of a lot of smaller platforms, like you said, that are either niche interests. There's already there was one that I saw last week that's like just for hunting and fishing. There's an app that's just for moms and like home building and home budgeting and what's it called, private education, like homeschooling kind of stuff, right? And you'll see, I think a lot of that is going to start to pop up, and so we may have, I don't know, 5 or 10 apps on our phone that allow us to pop in and out of the specific networks that we really care about. I mean, there was, Trump famously started his own, and so there's some of these others. I know that Elon Musk is going to start his own version of Twitter, at least that's the rumor.
That brings me to my next question, which is is there a platform that you would like to see disappear altogether?
I mean, I don't like any of them. I hate all of them currently because they're based on this model. I am weird in that I believe in paying for value, and I believe in creating value. So on the startup side, and this might segue to our last segment of the mistakes that founders make and how they can, what we often see in patterns that we can identify. But I think that we as human beings should be willing to pay for value. Otherwise, we have to suffer the consequences of what does free mean.
Yeah.
Because nothing's free. Let's just be honest. Nothing's free. There's some way that some things have to get paid for.
Yeah.
And so I think that I would like all the current social networks to go away. And I'd love to see the rise of new social networks that give us the ability to communicate and interact, but protect our data, are based on like blockchain, type principles, and that don't advertise to us unless we have explicitly given permission to be advertised to, and it's highly targeted, highly relevant advertising to us.
I think as both of us having one foot in the Silicon Valley, the physical world, right? And understand, watching all of that, but also being outsiders and questioning that. I lived in the Bay Area when Facebook was on its rise. And remember being like, why aren't they charging us to upload more pictures, right? Like the average album was 60 pictures, and you would see people create like 4 albums for their pictures. And I was like, I really think people that are paying like $1 to nudge people or $1 to send stickers to people would pay $1 to,
Store their data.
have a
Yeah.
photo album with 180 pictures, so I think you and I share the criticism of, never, wanting to support startups that have real business models.
Yeah.
And so this switches to the next headline because there's two more. The other trend for this year though is like the secret, I don't think it's secret invasion of the super apps. So like at the same time that people might be shifting away from these apps, there's still a massive clash of super app level platforms vying to dominate consumers' online lives, whether it's Google or Facebook or whatever. So like, do you think that that's a result of people moving away or something else?
Yeah, and there's this real problematic catch-22 in that you get the rise of all these, disparate niche networks, but a lot of them are venture funded. And so the venture capitalists are saying, what's your exit? And then their exit is they get bought by one of the massive networks. So the dirty little secret that a lot of my family members didn't know, even till just recently, I'm telling them, you guys know that Facebook owns Instagram and owns WhatsApp. So,
right.
It's all Facebook. And they're like, it was amazing to me that a lot of people still didn't realize that. Right?
Still didn't realize that, like, hey, you got off Facebook, but you created a private group on WhatsApp.
Yeah. So your data is still going. Yeah. If you hate Mark Zuckerberg, it's hard to get away from him, right?
Right.
And so we've got this challenge where I would love to see the rise of these independent networks, but it also almost feels inevitable that for those founders to get a meaningful exit for themselves and their employees and for the investors who invested in them, that there'll be a real big temptation to get sucked into the Borg, right? And so I've been contemplating and thinking, and I don't have a solution for it yet, other than it is one of my life's goals to create a venture firm that will invest in businesses that have profitable business models, like you and I have talked about, and that's been my investment thesis so far. I don't invest in
which seems like it shouldn't be so out there and crazy.
I know, but it's crazy. It's crazy.
It is something that you have to specify, is that I invest in startups with real business models.
With a real business model. That's not just eyeballs, and it's not purely ad supported. I do invest in ad tech, and I'm actually building some ad tech myself, but it's totally in the opt-in permission based. Like it's not, sneakily steal your data kind of. I hate that model. Mm-hmm. So the trick will be, can we create these other social networks that can sustainably remain independent forever and not get sucked into, one of the big 2 or 3, if you call it Microsoft, Google, and Meta, right?
Yeah. Yeah. So Meta also announced today another round of 10,000 layoffs, and they want to point to partly due to Apple's introduction of privacy features 2 years ago that they still haven't recovered from. And that would be an example of these super apps kind of clashing with each other. Apple, Facebook blaming, or Meta blaming Apple. If anyone listened to like 2 episodes ago, talked about Meta, wasting $13 billion pursuing the metaverse last year just so Mark Zuckerberg could cover up the bad job his platform did on information security during the past 5, 6, 7 years. So now this one's going to bring us back to kind of Silicon Valley and like where we go from here with fundraising. But the other trend is that VCs will stop hunting unicorns. that basically says investors will go back to the basics, look for resilient entrepreneurs, and be, this part may be arguable, more realistic about expectations. So what do you think?
I think that's false.
Mm,
Even though I don't want it to be, I want the sentiment to be true, but here's why I think it's false. There are so many different investment vehicles, ranging from real estate to private equity funds to just the stock market and index funds,
fun.
to long-term treasuries and hedge funds. There's so many places that people can put money. The reason venture funds came about and exist, and in my opinion will always exist, is in that higher risk, higher reward category. And the truth of the matter is that all investors suck at identifying good companies. And any VC or any investor that tells me otherwise, I think they're full of crap and they're in denial. And this is me speaking as an investor too. The venture capitalists, the people that I respect, are the ones that at least have the decency and the self-awareness to say, look, we're gambling. We suck at, there's some basic principles, but basically we're gambling. And the truth of that is, if they weren't gambling, then they wouldn't need the top 2 or 3 companies out of 20 to 30 in their portfolio to return all of their fund. Right. And everybody likes to brag about, oh, I was in Uber early, or I was in Airbnb early, or whatever. But they don't talk about the 30 other companies that totally imploded that they put millions and millions of dollars in. Nobody talks about that.
Right.
But they all do. That nobody's batting 1,000. Nobody's even batting like 500%.
Right.
So, or 50%. They're not batting 500, right? So the truth is that because of this combination of like, all investors suck at picking good companies, and it's really just kind of educated gambling. There's this combination where investors will always want a vehicle to be able to put their money that has this potential for outsized returns, like 5x, 10x, 100x their investment. There will always exist a world where it's grow at all costs, kind of swing for the fences, like go for broke kind of attitude. And a lot of the VCs who are like, hey, let's rein it in. Let's focus on the fundamentals. Let's focus on profitability. I think a lot of that is just rhetoric. I think a lot of it is just they're saying what they think they should say or what people expect them to say. But really, if all investors were only focused on the calm companies, to use a term I heard from Tyler Tringus, like the companies that have just slow growth, consistent profitable models, they would never get the big, huge, the massive hits. Mm-hmm. And that's kind of what makes them famous, and that's what makes them a lot of money. And so I think there's always going to be this place where people are swinging for the fences, and that means a VC is going to be telling you as a founder, go for broke, this is grow at all costs. This is focus less on profitability and more on top line revenue. And that's just I think there's always going to be that kind of pressure, I think, on those types of startups.
So we might see some angels and venture funds join you on putting a real business model into their investment thesis and criteria, but we still are going to see venture funds swinging for the fences, looking for those unicorns, because at the end of the day, and I have a YouTube video that I will also make sure is tagged, explaining what Dave talked about, whereas like out of 10 startups, you have to believe all 10 are going to 100x your returns. The reality is half of them are going to go under, 2 or 3 might just break even, and then the other 2 are going to cover all of your losses.
Yeah, return all of your amazing returns.
Right, all of your amazing returns. Yeah. And so you have to have some wild ones in that portfolio. So you have to have some of those unicorns. If they weren't there, then VCs would probably stop VCing altogether.
Yeah, we wouldn't need venture capital funds. We would just be doing like private equity or friends and family rounds, and just everyone to be running their companies like a calm company, I guess.
Yeah, I've heard that term as well to reference startups. Maybe you would just call them small businesses. There's a whole other argument about what is a startup, but that are growing more steadily, organically, judiciously. So that brings us to our final section, which is a deep dive. We've kind of been deep diving this whole time, but Silicon Valley Bank and how this really affects fundraising for our pre-seed, seed, Series A startups, the younger ones that maybe have a business model, haven't totally proved that business model out. The kind of hot take that I got just an hour before we got on the phone through a more traditional financial expert and an angel, then through an angel. So it's a phone line conversation. I might have missed some pieces. Because of kind of the instability of FDIC insured financial institutions, we may actually see people diversify some of their finances into non-traditional assets, i.e. startups being one of those commodities. So we might actually see some angels become looser with their purse strings as they want to move cash out of like the traditional S&P, NASDAQ the traditional financial markets that we talk about, in the public. So what do you think? What do you think is going to happen with angel investors? What do you think is happening with venture funds? If you had a seed startup that was in the middle of raising a round, would you tell them to pause for a couple months? What's the advice here?
Let me start at the end and then work back to the beginning of your question. I'm telling startups to be as aggressive as you can. It is tough. The environment is really, really tough. It was already kind of chilly given the talk of recession and everything else that before the bank issue. And then that's just kind of added fuel to the fire for a lot of investors saying like, hey, we're going to hold back. We're going to pause. We're not going to invest in any new investments for a little bit to see how this all plays out. And before the Fed did what they did, there were some that were saying like, we have to keep all of our dry powder in order just to help our existing investments potentially make payroll or whatever in the term of short-term loans. And then we'll circle back to like making new investments after all the dust is settled. And there's even still some of that sentiment, even with the Fed's actions, just because of the timing of when that cash will reach everybody. But I think that I think startups should be aggressive about their fundraising, and I think there's a unique opportunity for the venture capital firms to not follow the herd mentality of everybody pulling back and everybody waiting and seeing. I think some venture capital firms could look at this as an opportunity to snatch up a lot of good deals, a lot of cool new startups and steal those away from maybe some of the bigger, more well-known venture firms. While those guys are sitting on the sidelines, like there's an opportunity for someone to zag while everyone else is, zigging basically.
I really like that.
Yeah. If I had my own fund, I would actually get more aggressive about looking at startups and making investments while everybody else is like waiting to see what happens. I think that creates an opportunity. I see opportunity in that. And I think that the founders are just going to have to be more persistent. It means that there's a lot more conversations probably required to find the right kind of investment partner. It means that they are fighting against this tendency from a lot of the firms to just take a wait and see approach. The flip side that entrepreneurs need to know, and this is part of like doing your research, doing your homework, is if a fund has recently closed a new fund. So, most venture firms have multiple funds, fund 1, 2, 3, 4, 5, some are on their 10th fund or whatever.
They might have capital to deploy.
Yes, they have a ton of capital, and their LPs, the people who've given them that money, expect them to deploy that capital and put it to use. They can't just sit on the sidelines forever. They've got to eventually deploy that capital.
Right.
And so there's risk on the venture side of waiting too long and not deploying your capital or being too conservative, especially if you just closed a big round. So I'm telling the founders to look for the funds that have recently closed a big round of capital, and look for the ones who are, at least on like Twitter or on social media, have taken a little bit more of an opportunistic view of all of this, instead of like, whoa, we got to, rein everything in and pull back. And then I think there's opportunity for both the venture capitalists and the founders, to find a good marriage in what could be a unique opportunity for the venture capitalists who are just a little bit more bold and aggressive, rather than just following the rest of the sheep into like waiting and seeing.
So Dave's advice is for venture funds is think for yourself.
Yeah. Contrary, do what nobody else is doing, basically.
And you have to forgive me, because I'm from Philadelphia, my mind's been in football for like a lot longer than other people in this country the past few months. And I think one of the things, Howie Roseman, our general manager for the Philadelphia Eagles, he's had a very successful career creating teams over the past decade. And someone asked him at the combine 2 weeks ago, whether he thought that other teams were going to follow his strategy. And he said, once you see yourself in a position of following other people's strategy, you're too late.
Yeah.
Right? And I think that is really important for the venture funds. So there was another opinion I read about what startups should be doing. Charlie O'Donnell, he is a managing director of Brooklyn Bridge Ventures, and he writes a bunch around the New York City ecosystem. And his kind of hot take was for startup founders, not to tighten their purse strings as far as going after customers and growing. There's an instinct with everyone to hold their purse strings. And for founders, they might say, okay, we're going to grow more slowly to preserve our runway. That means that if you pitch and you're not showing these numbers, investors that are willing to invest are going to say, well, it looks like I can afford to wait on you. And there's still this FOMO that entrepreneurs have to play off of when fundraising. And so he was saying, really double down on speeding up your acquisition. And that's kind of so that you stand out for investors. And that's what you're kind of saying to investors too, is you should double down, because everyone else's kind of gut is to hold on.
Yeah.
Right?
Yeah. I believe that the venture capitalists should now be a little bit more aggressive and finding good companies to deploy their capital in. But the irony is, I still believe that startups should be that focus on the fundamentals of their unit economics and their business model. And I don't believe in pandering to, I totally agree that with that statement that that's what investors kind of are looking for. But I would prefer, if I'm in the founder's shoes, I would prefer to find an investor that says, hey, you guys have been running your business really intelligently, really wisely, really carefully, and we can come in and give you that growth capital to help you accelerate that. But we can still accelerate the growth while focusing on profitability and not grow at all costs.
Right.
I don't want to partner with a venture capital firm that has the attitude of grow at all costs, because I think there's a lot of negative side effects of that, that even negatively impact employees. There's a whole other conversation we could have about equity beyond the core founders equity, and why do options never end up, being worth anything for any employees? It's partly driven by this, grow at all costs, and the options are common compared to preferences that are stacked on top of it, and they never end up, unless it's like, Meta or Google or one of those big ones. It's rare that the lower level employees walk away with anything, and so it's this false promise of, hey, we're doing this because your equity is going to grow, and then it's all, it's all
right.
There's nothing there when you get to the end. Yeah. But that's a whole nother,
right. Should you take options? And we don't want to make it more complicated for people. So it sounds like if we're gonna kind of make sense of the Silicon Valley Bank fallout, what startups should be doing is probably the advice we'd give all the time. Focus on the fundamentals, top line revenue, unit economics, gross profit, how much you actually make that you can cover your employee's salary, stuff like that. And with venture funds, it has to kind of, they're still going to play. There's still going to be a bunch that play risky this year. Will shoot for those unicorns. They have to. It's just the nature of that financial asset. Any other kind of make sense summary points you want to share?
No, I think it's going to be hard. I do think the environment is tougher, but my only advice would be don't give up, don't get discouraged, and don't slow down. Don't let the rhetoric that's out there, the narrative that's like, oh, the fundraising environment's really hard, and oh, VCs aren't going to invest because of the Silicon Valley Bank or any of this, or the recession or whatever. Don't let that message slow you down or depress you. I think you as an entrepreneur, you've got to be resilient. You've got to be persistent. You've got to follow your passion and your cause, your purpose. And it is going to be harder, but I think that if they're out there and they're knocking enough doors and they're making enough calls and they're networking into enough firms, they'll find that one smart venture firm that's actually, putting the pedal to the metal rather than putting the brakes on. And it could be a great marriage for them. And, and that would be the right partner to have, I think, in these kind of circumstances.
So before we sign off, Dave, where can people find you? I know you just don't really like any of the social platforms. Do you want people to find you?
I'm on Twitter. I'm at David Oldham. So David instead of Dave. I'm at David Oldham on Twitter. I'm on LinkedIn. I think I'm /Dave Oldham on LinkedIn.
Switching it up.
Those are the two places I mainly hang out for business stuff. I have an Instagram account, but I'm more of a voyeur than a poster there. And it's just like my friends and family that, I don't really do much business-y kind of stuff on Instagram.
Yeah, no. So, all right. Well, thank you for listening to Make Sense with me, your host, Lindsay Tabus, and guest, Dave Oldham. If you want to continue to be the smartest person in the room, hit that subscribe button for next week's episode. Every subscriber on YouTube makes a huge difference, and they run ads on my videos. But since I don't have 1,000 subscribers yet, I don't
Smash that subscribe button.
Smash it. And we'll see you next week.